If you invested $10,000 in the S&P 500 5 years ago, you would likely be sitting on a very comfortable profit right now. However, if you use that same capital to trade options without a strict strategy, data suggests you could have lost it all in months. This massive difference in outcomes is why choosing between stocks and options is the most critical financial decision you face in 2025. Many beginners are seduced by social media screenshots of massive overnight gains, ignoring the silent majority who wipe out their accounts. Today, I'm breaking down exactly what I would do if I were starting from scratch this year with a goal of building lasting wealth. The fundamental difference is that stocks represent actual ownership in a real business, giving you a claim on future profits. When you buy a share of a company like Apple, you are betting that the business will grow and generate value over the next decade. Options are derivative contracts that essentially allow you to rent the price movement of a stock for a very specific period of time. This introduces a concept of time decay, which means your investment loses value every single day the stock price stays flat. If I were starting in 2025, my first reality check would be my available capital, as the barriers to entry are vastly different. You can start investing in stocks with $5 using fractional shares on almost any major U.S. brokerage app. This allows you to build a diversified portfolio of high-quality companies immediately, regardless of your current income level. Options trading effectively requires a margin account and at least $2,000 to access safe strategies. Furthermore, the pattern day trader rule requires a $25,000 balance if you want to trade frequently without restrictions. For anyone started with less than $5,000, I would focus 90% of my effort on accumulating stocks. The psychological stress of watching an option contract lose 50% of its value in an hour is not for the faint of heart. With stocks, if the market dips, you still own the shares and can simply wait for the economy to recover. With options, you are fighting the clock, and if the move doesn't happen by Friday, your contract can expire worthless. Let's also talk about taxes, because the IRS treats these two investment vehicles very differently. Holding stocks for over a year qualifies you for long-term capital gains rates, which are significantly lower than income tax rates. Most options are short-term trades, meaning your profits are taxed at your highest ordinary income bracket, eating into your returns. However, options are not evil. They are just complex tools that are often misused by beginners looking for a lottery ticket. If I had a larger portfolio, say over $20,000, I would use options to generate income, not to gamble. Selling covered calls on stocks you already own can generate monthly cash flow, acting like a rental payment on your assets. This changes the dynamic from betting on a massive price spike to generating consistent income from a stable portfolio. But for 2025, my core strategy would be to trust the historical resilience of the broader American stock market. The S&P 500 has historically returned about 10% annually on average, doubling your money roughly every 7 years. Trying to beat that average with options requires immense skill, emotional discipline, and a willingness to lose money learning. One of the biggest traps for new investors is the allure of leverage, thinking they can turn small cash into millions quickly. Leverage amplifies losses just as fast as gains, and one bad trade can destroy months of hard-earned progress. If you are dead set on trading options, limit your exposure to just 5% of your total portfolio value. This barbell strategy keeps your money safe in stocks while allowing you to take small, calculated risks for high rewards. For the stock portion of my portfolio, I would focus heavily on broad market ETFs to eliminate single company risk. Buying an ETF that tracks the NASDAQ gives you exposure to the tech boom without betting the farm on one company. This is crucial because while the tech sector may grow, individual companies can fail due to bad management or scandals. Another reason to prefer stocks in 2025 is the ability to reinvest dividends, compounding your growth automatically. Options do not pay dividends. In fact, as a buyer, you're paying a premium, which is a constant drag on your account. Successful investing is rarely about hitting home runs. It is about avoiding the strikeouts that take you out of the game. Time in the market beats time in the market, and stocks are the only asset class that truly rewards patience. If you hold an option too long, it dies. If you hold quality stock too long, it typically grows. I would also pay attention to the current interest rate environment. which affects how expensive it is to borrow on margin. High rates make margin trading costly, further incentivizing a cash-based approach to buying and holding stocks. If you are building wealth while working a full-time job, stocks are also far more respectful of your time. Active options trading requires you to stare at charts all day, while stock investing can take less than an hour a month. Your time is an asset. Spend increasing your primary income so you have more capital to invest each month. The more money you contribute, the less risk you need to take to hit your financial goals. A large portfolio earning a boring 7% return will always beat a tiny portfolio taking massive risks. So, here's my concrete plan for a beginner starting their financial journey in 2025. Open a brokerage account and set up an automatic transfer of whatever you can afford, even if it is just $50. Allocate 70% of that money into a total stock market index fund to capture the growth of the entire economy. Put 20% into a sector you believe in for the next decade, like AI, healthcare, or clean energy. Keep the final 10% in cash or short-term bonds to buy the dip when the market inevitably corrects. Only once you have reached your first $10,000 should you even consider looking at the options chain. And when you do, start by paper trading, using fake money to test your strategies before risking a single cent. You will realize very quickly that predicting short-term price movements is incredibly difficult, even for professionals. Most hedge funds struggle to beat the market consistently, so do not expect to do it in your spare time. Real wealth is built through ownership, discipline, and the magical mathematical force of compound interest. Treat your portfolio like a business that you plan to run for the next 30 years, not a casino visit. If you adopt this mindset, you will be miles ahead of the crowd that is still chasing the next big squeeze. The market is a device for transferring money from the impatient to the patient. So be the person who waits. I want you to comment stocks below if you're playing a long game, or options if you're trading for income. Don't forget to subscribe to the channel so you don't miss our breakdown of the best ETFs for this year. Your future self will thank you for the boring, consistent work you put in today.